buy, borrow, die. 3 words. That is the complete tax strategy the wealthiest families in America have used for generations to build billions and pass them on without ever paying capital gains tax. Not some of it, all of it, zero. I'm going to show you exactly how it works, why it is completely legal, and how to run a version of it starting with whatever you have right now. Before we go any further, understand one thing. This is not a loophole. It is not a gray area. It is not aggressive planning that gets you audited. Every mechanism I'm about to explain is written into the United States tax code. The IRS knows it exists. Congress knows it exists. The only reason you've never heard of it is that the people who use it never needed you to know. In 2021, the newsroom ProPublica obtained 15 years of IRS records on the wealthiest Americans. Here's what they found. In 2018, Elon Musk, then the second richest person alive, paid $0 in federal income tax. Jeff Bezos paid $0 in 2007, and again in 2011. Not through fraud, through 3 words: buy, borrow, die. This is the finale of Fortress Wealth, and it is the mechanism every other episode has been pointing toward. Here is the entire machine in one breath. You buy an asset that appreciates. You never sell it, because selling is what triggers the tax. When you need cash, you borrow against it, because a loan is not income, and the IRS only taxes income. And when you die, your heirs inherit that asset at its current value. The original cost resets, and every dollar of gain you built over a lifetime vanishes from the tax code. Permanently. Watch the math, because the math is the whole argument. You buy $1 million of an asset. Over decades, it grows to $50 million. That's $49 million in gains. Sell it, and at today's top rate of 23.8%, you'd hand the IRS roughly $11.7 million. But you don't sell. You die holding it. Your heirs inherit at $50 million. The capital gains tax owed? $0. The $49 million in gains simply never existed for tax purposes. That is not my opinion. That is Section 1014 of the Internal Revenue Code. Phase 1, buy and never sell. This is not a feel-good investing slogan. It is a tax mechanic. Under the realization doctrine, Section 101, a capital gain is only taxable when it's realized. When you sell, while you hold an asset, its growth is completely invisible to the IRS. A $10,000 position that grows to $10 million owes nothing every year until the day you sell. So the strategy begins with a single discipline. If the tax event only arrives when you sell, then don't. Here's the difference that builds the entire wealth gap, dollar by dollar. When a middle-class investor wants cash for a car, a vacation, a renovation, they sell an appreciated asset, pay the tax on the gain, and spend what's left. When a wealthy one wants cash for the exact same things, they borrow against the asset and keep every dollar compounding. One family interrupts the compounding to pay a tax. The other never does. Run that for 30 years, and it is the whole ball game. And it compounds harder than you think. $1 million growing at 10% for 30 years becomes about $17 million. But sell and rebalance along the way, paying capital gains each time, and you land closer to 11. That $6 million gap isn't the tax rate, it's the tax drag. The compounding you lose forever on every dollar you pulled out to pay the IRS early. Phase 2 is the part nobody explains at your income level. Stay with me, because this is where it stops being theory. Phase 2. Borrow. Under the most basic definitions in the tax code, Sections 61 and 163, loan proceeds are not income. They're a debt you have to repay. So when someone pledges $10 billion of stock as collateral and borrows $500 million against it, they have not earned $500 million. They've borrowed it. The IRS taxes income. Debt is not income. That cash funds the lifestyle, the investments, the philanthropy, and generates a $0 income tax bill. That's not a trick. That's the definition of a loan. In 2018, Elon Musk paid $0 in federal income tax. The IRS has the return. ProPublica published it. And across the 5 years from 2014 to 2018, his wealth grew by nearly $14 billion, while his true tax rate, measured against that growth, came out to 3.27%. Why? Because stock that goes up is not income. It's unrealized. You borrow against it instead of selling it, and the loan isn't income either. Wealth went up by billions. The tax bill rounded to nothing, completely legal, exactly as the code is written. And Musk is not the outlier. Larry Ellison, Oracle's founder, has done the same thing at scale for decades, pledging hundreds of millions of his Oracle shares as collateral for personal loans. Public SEC filings show it plainly. Well over 270 million shares pledged, tens of billions of dollars in collateral, so he never has to sell, never triggers the gain, and keeps control of his company. He doesn't sell his stock, he borrows against it. And the more he borrows, the more the underlying keeps compounding behind it. Now the obvious question, doesn't the loan cost money? Yes. And here's the arbitrage. Even today, with the prime rate at 6.75%, the largest borrowers get securities-backed credit at a spread below prime. Call it the high fives to low sixes. Compare that to the tax, 23.8% on a sale. You are paying single-digit interest to avoid a more than 20% tax. And crucially, you pay interest only on what you borrowed, while the entire asset keeps compounding behind it. The interest is a rounding error. The tax would have been permanent. This pivot is the retention bridge. It converts billionaire outrage into, I can actually do a version of this. And before you decide this is a billionaire's game, it isn't. The same mechanism scales down to you. The instrument changes. The structure never does. 3 levels. Entry. If you own appreciated property, a home equity line of credit pulls tax-free cash out of that equity without selling. Available at almost any bank this week. Mid-tier. If you have a brokerage account, Fidelity, Schwab, and Interactive Brokers will lend against it, a pledged asset line, while your portfolio stays fully invested and keeps compounding. Top tier. Private banks offer securities-backed lines of credit in the millions at prime-adjacent rates. One hard rule, because this is where people blow themselves up. Never borrow more than 30 to 40% of your collateral's value, no matter what the lender allows. If the asset drops and you're over-leveraged, you can be forced to sell at the worst possible moment, and that detonates the entire strategy. Borrow conservatively, or don't borrow at all. Slow everything down. This is the mechanism that makes the other two permanent. Phase 3. The one that makes the other two permanent. Die. Under Section 1014, when your heirs inherit an asset, their cost basis is reset to its fair market value on the day you die, not what you paid. So if you bought at $1 million and it's worth $50 million at death, your heirs inherit at $50 million. If they sell the next morning, the capital gain is 0, because on paper, they paid $50 for something worth $50. A lifetime of appreciation erased from the tax calculation entirely. This is why it's buy, borrow, die, and not buy, borrow, sell. Selling triggers the exact tax the borrowing was built to avoid. Dying eliminates it. Not defers, eliminates. The IRS collects nothing on 50 years of growth. The outstanding loan gets repaid from the estate, and because those assets stepped up at death, even that repayment triggers no gain. The loop closes clean. And it doesn't stop at one generation. The heirs hold the stepped-up assets. They borrow against them. They die, and their heirs get another step-up. Each generation wipes out the gains accumulated on its watch. Put it inside a dynasty trust, the structure we built back in episode 1, and the assets outlive the people who own them. With the federal estate and gift exemption now at $15 million per person, $30 million per couple, the structure moves enormous wealth before estate tax even enters the conversation. This is how old money stays old money, not better investing. A tax structure that never lets compounding get interrupted. One honest caveat. The step up in basis has been a target before. The 2021 proposals to tax unrealized gains at death came close enough to name. As of this recording, June 2026, it is current law. But verify it before you act with a qualified tax attorney, which is exactly why building the rest of the fortress is not optional. You never want a strategy that depends on a single provision surviving. Here's the truth underneath all 4 episodes. The step up in basis has been in the tax code since 1921, over a century. It was not put there by accident, and it is not disappearing tomorrow. It is the quiet foundation under nearly every great American fortune that compounded without interruption. We started this series by showing you how the wealthy protect money, then how the banks move against you, then how Wall Street repositioned, and it all pointed here, to the 3 words that turn a lifetime of building into a tax-free inheritance. Buy, borrow, die. This is not a finance channel. It is a blueprint for building something that outlasts you. 4 episodes. 1 mission. 0 to Dynasty. Now you know why.